Today on the Cameron Journal podcast, we are talking about banks, banking, and money. This is very exciting. We're going to talk about the history of banks, how they affect our lives, how they work, what they are, how the whole banking thing goes down. So, get out your deposit slips and get ready. It's the Cameron Journal podcast. Let's go. This is the Cameron Journal podcast. It's a place where we talk about important things. It's a place where we bring a little slice of the news to you. It's a place where we do important things, have important conversations. It's also things that I like to talk about. My name is Cameron Cowan, and this is the Cameron Journal podcast. Banks. We love to hate them. Banks have become a sort of punchline in our modern era thanks to the financial crisis, but the reality is that most people are dependent on them for their financial services. Most people have credit cards, debit cards, and others have investments that are all held and managed by banks. They allow your employer to pay you out each week or 2 weeks, and they allow you to be able to freely spend those funds either in cash or over the internet. They lend money to businesses so that they can expand without having to have the ready cash on hand. They allow for a sophisticated and modern economy, and this gives them unprecedented power, as we all found out in 2008. Banks are a part of our everyday life, but most banks don't have a recognizable brand that most people would recognize. Only a few banks like Wells Fargo, Chase, Bank of America, and Capital One have large national presences that people know about. There are other banks like BNP Paribas, New York Mellon, Goldman Sachs, First Fifth, and others that are much less known. This doesn't even begin to touch clearinghouses and other private specialty banks that are an important part of the economy and keep capital moving so that people have jobs and in turn spend that money on the things that they need. Banking is an important part of our lives, but most people don't know much about it or the history of it. Most importantly, people don't understand how much of our lives banks really control, because they control the money. Ancient Babylon boasted the first institution that operated like a modern bank. The currency used was grain, and people could deposit their grain at the bank and write checks against it. People could also get small loans. This type of banking would be common throughout various ancient empires. Once currency supplanted the barter system, currency had to be stored, used for credit and trade. The government was involved in the issuance of currency, but not in its storage or other business. This allowed temples and other companies to be the middle people who moved the wheels of the economy. However, banks and banking did not have a central role to play in the lives of everyday people. Most people, being poor subsistence farmers, did not need or use banks. These early banks catered primarily to traders and merchantmen who had currency that needed storage and who needed to borrow money for various operations. Temples were also some of the first ancient banks. In the ancient world, temples were not just a place to go to church or worship, they were the centers of society. A familiar story is Jesus driving the money changers out of the temple in the Bible. In ancient Hebraic society, money changing and other commerce was not allowable at the temple, but due to the infiltration of Roman ideas into Judea, the same system of commerce had been set up around the Jewish temple. The biblical myth of Jesus driving the money changers represented him attacking the pagan practice of money lending and changing at the temple. Temples were a place to change money, get a loan, buy needed supplies for worship, and conduct other business. For temples, this was a vital source of money for needed operations. For the community, it was a safe and trusted place to do business. The transactions were small, but they were the only place for capital to be organized and deployed. The Romans boasted the first institutional banks that were backed by law. Roman banking was expansive, especially with a single currency used across the entire empire, often in addition to other local currencies. As antiquity ended and the first underpinnings of global trade began, banking for trade became a big business, and one family in Florence would make a fortune that survives to this day on banking. The first modern banks began in Florence. Banks would usually be chartered by the crown, due in part to mercantilism and a tight control of the economy, as well as regulation of anyone dealing with money. The infamous Medici family formed the first modern bank in 1397. At one time called God's banker, their wealth from banking brought the family into the highest echelons of power in Europe. The Vatican was a client, and they had branches in almost every major city in Europe. The family married into nobility, and the Medici family members were in the Italian aristocracy until 1737. The family also produced two queens in France during the height of its power. Cosimo inherited an established bank and turned it into an international empire. They made the florin, the currency of Florence, into the American dollar of its day. It was the reserve currency of the 14th and 15th centuries. The modern banking system grew out of a simple problem for the aristocracy. Due to feudalism, the aristocracy was often land rich but cash poor. When it came time to finance major expeditions, like war for example, it could be difficult to raise funds just on the yearly tax revenues that the landed aristocracy received as their annual income. They needed to borrow money using those tax revenues as collateral, and that's the service that the Medici Bank provided to its wealthy clients. One of the ways banking expanded in a monetary-based economy was through lending to governments. This was pioneered by Giovanni de' Medici de' Medici, who founded the Medici Bank. Using his tremendous family wealth, they were able to finance a variety of artistic projects in 13th century Florence. Later generations of the Medici family would also become patrons of the arts. The conspiracies around the family and their banks is legendary in the shadows of the internet. The Medici family is an excellent example of the power of capital. Giovanni expanded the fortune when he loaned money to governments to fund things from civil projects to wars. This is an area where banking, capitalism, governments, debt, and religion converge together in a confluence of financial interest. Cosimo used that wealth to patronize churches, the arts, and sciences. Giovanni, the founder of the banking dynasty, and his heirs like Cosimo, created methods of banking and business that are still in use to this day, like double-entry bookkeeping, and a basic system of credit using letters of credit and currency exchange. The Medicis were often, both at the time and in history, referred to as the true rulers of Europe because they controlled the flow of capital around the continent. King in all but name, as one pope put it. Their power lasted long after the bank collapsed in 1494. While the bank collapsed until a new version, still owned by the family, popped up in Puerto Rico in 2019, the fortune did not, and the Medici's influence in Renaissance Europe continued. Although the Medicis invented modern banking to a point, other civilizations were getting on in the storage of money for trade. The Chinese introduced the world's first paper money in 960 under the Song dynasty. From that point onward, China had small banks for local commerce and larger banks for government services and large traders. China did not develop an international profile in banking until the late 20th century, as China was closed to foreign trade until the late 19th century. China is a unique culture when it comes to banking and finance because of its weak legal structure. Unlike the West, business in China is less about the law and solving problems in court, and more about the networks of intimate personal relationships and friendships between the people involved in the companies. While this often kept banking out of the government purview, it also relied on a complicated system of social favors and gifts in order to build trust over time for business relationships. If a trader wasn't trusted by a bank, there was almost nowhere he could do business. He simply couldn't cross the street and go to another bank. He would have to begin again by developing a personal relationship with the owner of the bank. Trust takes years to build. This also often kept competition to a minimum. Even to this day, business in China operates far more on personal relationships than it does on China's legal framework. Banks in China are now almost all state-owned, despite the opening of China's economy in 1989. Banking, as such, would continue in Europe on the Medici model, and that would become the basis of the entire modern banking system. The fact that they were so powerful without having any title in church or state shows just how powerful capital can be. When you control money, you care much less about who makes the laws. Remember that. It's going to be important.
Dopey, you didn't do it to me.
Still, at least you're gonna have some nice cash to walk away with.
I guess. Shit, this is really gonna affect people.
Yeah, it's gonna affect people like me.
Well, real people.
Jesus, Seth. Listen, if you really want to do this with your life, you have to believe you're necessary, and you are. People want to live like this in their cars and their big fucking houses they can't even pay for, then you're necessary. The only reason that they all get to continue living like kings is because we got our fingers on the scales in their favor. I take my hand off when then the whole world gets really fucking fair, really fucking quickly, and nobody actually wants that. They say they do, but they don't. They want what we have to give them, but they also want to, play innocent and pretend they have no idea where it came from. Well, that's more hypocrisy than I'm willing to swallow, so fuck. Fuck normal people. The funny thing is, tomorrow if all of this goes tits up, they're gonna crucify us for being too reckless. But if we're wrong, and everything gets back on track, well, then the same people are going to laugh till they piss their pants because we're going to look like the biggest pussies God ever let through the door.
At the founding of the United States, Alexander Hamilton promoted the idea of a national bank to make loans and provide a common currency for the new republic. However, many of the other founding fathers like Madison and Adams were not interested in financial institutions having that much power. Still, Hamilton got his way. The Bank of the United States operated until 1836 when Andrew Jackson abolished it. It was clear to the founders that bankers were an influential part of society, and they broadly wanted to prevent bankers from having more power than, quote, the people, in this case, white landed gentry like themselves, and did not want the young republic to be immediately drowned in debt on easy terms from a central bank who would influence policy. There was also the matter of the federal government becoming indebted to bankers. In 1811, when the first bank came up for renewal, it was narrowly defeated. When the Republic couldn't finance the War of 1812, Congress chartered another bank in 1816. The central bank would be a contentious issue well into the middle part of the century. Andrew Jackson was stridently against the central bank, hence his abolition of it when his charter came up for review. The United States would not have another central bank until the founding of the Federal Reserve System in 1913. State governments often also chartered banks. Banks proliferated throughout the 19th century, and as the Industrial Revolution took hold in the New Republic, banks, paper currency, and other services like loans became an important part of the economy. However, the earliest American banks, like the Bank of North America and the Bank of New York, were not part of any centralized system. They were independent and depending on their own capitalization in order to survive. This led to problems. Financial panics rocked the country throughout the 19th century. However, the need for a central bank became important again after a series of financial panics that had devastating economic consequences between 1895 and 1907. Banks in the 19th century issued their own paper banknotes to be used in lieu of actual currency, still held in their banks. When these were used to trade, anyone holding them could return to the bank in question and retrieve the same value they held in paper in silver or gold. This also meant that the U.S. really had no central paper currency. If a bank went under, the paper currency was worthless. Banks would be liquidated and all their deposits would go to anyone with a liability at the bank. There was no deposit insurance of any kind, and no way banks could easily borrow from each other to form a central force to cover the liabilities. A whole panic could be started if too many customers took out too much money at once. If rumor got around that a bank was in trouble, a run on the bank could occur with people coming in and demanding their money. The Federal Reserve was supposed to stop all of these problems. By creating a network of interbank lending that was managed by a central bank, these sorts of bank runs, financial panics, and unregulated currency was all supposed to end. It did, in principle. However, things like deposit insurance would not become standard until after another great financial crisis, the Great Depression.
Building a global business is all about ambition. The success of that ambition depends on your global network and how you manage it. At HSBC, we understand how frustrating it can be. Multiple accounts across the world, financing options based only on your local performance, capital and liquidity inefficiencies, and high barriers to entry in new markets. We can help. Our international subsidiary banking teams around the world harness the power of our network to help you succeed. We serve over 8,000 global corporations across more than 50 countries and can offer you dedicated teams structured to mirror the way you work across parent and subsidiary levels. Tailored solutions that provide greater cost efficiencies, better use of working capital, and help in reducing cross-border risks. A consistent service to enable you to grow at scale. A central technology platform that will help you track your finances in real time, and access to our global network of experts, empowering you with insights and connections. We are your banking partner now and for the future, offering a global approach for global businesses. Please contact us today for further information.
The Great Depression started when the value of stocks in the stock market started to fall due to an untimely sell-off. No one quite knows whatever caused that sell-off. Many people had taken out loans against their stocks, usually to buy more stocks or bonds, and soon margin calls, that is, people asking for more money to secure the loan against a falling asset, ruined people financially by sucking up all their cash on hand, while also simultaneously being unable to borrow. People began getting laid off and needing cash. This led to people pulling money out of banks. You see, banks don't keep your money. They loan it out and keep only a small fraction on hand. It's called fractional reserve banking. I'll explain more about that in a moment. The Federal Reserve was supposed to stop this very thing from happening, but the problem was so big and the amount of money needed so great, the Federal Reserve could not meet demand, and indeed, they decisively chose not to fully meet demand for new money to keep banks capitalized. Markets collapsed and people suddenly found they had no job, no cash, employers who couldn't pay them, and rather than turn on the spigots of money, the Federal Reserve and Andrew Mellon, the Treasury Secretary, actually raised interest rates until 1933 and caused a double-dip recession, which led to the lowest days of the Great Depression. Decades later, banks would become one of the first areas to look for ways to deregulate as a way to expand operations. In 1976, Congress allowed branch banking, which allowed banks to work across state lines using branches that did not have to be accountable for every deposit on file or dollar loaned out. This early deregulation led to the late 1980s savings and loan crisis, where taxpayers bailed out several companies who'd overextended themselves due to excessive lending in the housing market. The lack of regulations and financial activities and risk would also lead to the 2008 economic collapse. This is one area where regulations, although they might have been perceived as onerous, were born out of a need to protect people and their money. Due to the Great Depression and the numerous bank failures between 1929 and 1934, the Roosevelt administration instituted, in concert with the Federal Reserve, several new banking regulations to make sure banks did not fail and wipe out the life savings of average Americans. Banks were insured by the Federal Deposit Insurance Corporation, FDIC, and any banks not in the Federal Reserve System at the time quickly joined it for their own existence. Many of the more public parts of these regulations stayed, but many of the more technical aspects began to be dissolved in the years following 1977. Allowing the free movement of capital and credit was deemed to be necessary, and in the 1980s, there was a president in the White House who certainly agreed. Now, before we go on to all of that from my essay 1977, The Rise of Discounters and Deregulation, we need to talk about what happened in the early 80s. Because after the Great Depression, the money economy stabilized. Eventually, World War II came along, the economy recovered, things improved, jobs came back, all this type of thing. They did a lot of regulation on banks to separate deposit banks from investment banks, and they created a lot of regulations to make sure that the Great Depression would never happen ever again. However, in the 1980s, with the relaxing of those regulations, we began to get into a period called financialization. Banking is really the foundation of modern capitalism as we know it. Capitalism would be nothing without banks and banking. Banking is the backbone of the modern global economy. Banks handle payments, store wealth, and provide trillions of dollars in loans to corporations to produce goods and services, and to the government to finance the affairs of state. Banking is a very old system of storing wealth that stems from societies as early as ancient Babylon, where banks used grain as currency. Until the 20th century, most banks issued their own currency and exchanged it between themselves or a national currency. However, this led to unreliable currencies, and people were often left with nothing if the bank failed and the resulting currency became worthless. Centralized government-backed currencies became far more reliable and were easier to use than real gold and silver, or the bank-issued currency backed by those reserves. Now, most currencies are printed by central banks and backed by a national government. Central banks also provide security for smaller banks by allowing them to freely borrow money in order to stay solvent and not destroy the savings and wealth of the depositors. Along the way, as wealth grew, banks went from small, local, and regional institutions to global powerhouses of capitalism who have investments in locations all over the world. This ability was made possible by globalization and the global flows of capital. At first glance, it seems attractive. Capital seeks out places for a return, and companies and banks look for places to create return, value, and growth. New markets for goods and services are prime locations for this. Countries who need capital to begin their own industries are also places for increased chances on return. The Asian financial crisis, triggered by the collapse of the Thai baht, and the South American bank failures, triggered by a variety of problems stemming from socialist governments to bad investments, have shown that this pathway is fraught with difficulties, and those difficulties are frequently shouldered by people thousands of miles away from the problem. When it comes to powering the industrial means of production, banks are an integral part of the equation. Companies borrowed the massive amounts of cash that were needed upfront to fund production. When it came to buying machines, building facilities, and other capital-intensive projects, banks were on the front line of investing in businesses that would be able to pay back the loan money with interest. This was the first rudimentary form of capitalist practice. Banks invested in projects they thought had a good chance of making them money because their source of capital was the depositors of the banks. When people deposit money into banks, banks aren't merely keeping that money there out of convenience. They invest that money via loans to companies for a return. Then, from the interest they have made, that's the return, they give you a small portion for the use of your money and keep the rest for themselves. Savers who leave money in a savings account for 30 or more days receive a small amount of interest because the bank has loaned out the money and earned interest from it. Banks also make money from the government by loaning the government money and making interest off that too. They often handle transactions alongside the government, like they used to with student loans and home mortgages. The finances of any sophisticated economy are tied to the banks. So how do these banks actually work?
Well, no, Charlie, I didn't even ask him. We don't need Potter over here.
And I'll take mine now.
No, but you're thinking of this place all wrong, as if I had the money back in a safe. The money's not here. Well, your money's in Joe's house. That's right next to yours. And in the Kennedy house, and Mrs. Maitland's house, and 100 others.
If you were to counterfeit some US dollars at home right now, you could be punished for up to 20 years in prison with a fine up to $250,000. Yet in the world of finance, banks are not only able to print money, but they're actually encouraged by the government to do so. Banking is one of the least understood businesses throughout history, and yet they are the very places that people dump their life savings into.
Hey, we can just put that into your retirement account and make it go to work for you, and it's gone.
What?
And the more you look into it, the more absurd you realize it really is. So how does the business of banking really work? It's actually not as complicated as you may think.
So here's what we know about banks so far. You deposit money with them, they loan it out. Remember how I said banks don't actually hang on to your money for convenience, they loan it out to other people? Well, how they do that now is what's called fractional reserve banking. Before we look at modern banking, we need to think about how modern banks work and how money works. Unlike the relatively simple transactions of taking deposits and loaning out money like banks of the past, modern banking is much more sophisticated. When you open a bank account, the bank holds in reserve about 10% and then takes the rest and makes it available to loan out. It's still in your account, you can still access it and spend it, but the bank is already using that money to make another loan to someone else. This can be a credit card, business loan, whatever loan you like. Banks also sometimes use these assets to make investments. Now, when they still had Glass-Steagall in place, banks who took consumer deposits that were insured by the FDIC were not allowed to make investments. But that all changed in the 1980s. They got rid of Glass-Steagall, and they allowed deposit banks to also make investments. Now, all the money that's in the bank goes to what's called the bank's capitalization, i.e. that's how much actual money the bank has minus its liabilities. Banks, by regulation, have to keep a certain amount of money on hand to pay out to depositors, but the rest, i.e. the other 90% of your deposit, can be put out to loans. As long as the banks stay within their regulations, they're allowed to continue loaning out money. Now, this allows the bank to make billions of dollars in interest on all of these loans. Every credit card is a type of loan, and they're charging interest for that. That goes for car loans, home mortgages, everything that generates interest is all money going back into the bank. The bank gives a small portion to the depositor for keeping the money there, increasing their capitalization, and then they keep the rest of the interest as profit. And all they've done is broker the transaction. They also can make money off of brokering investments, which leads us to our friends, the investment banks. Now, in 2008, we all got an education on investment banks. Investment banks are different than the retail bank you use. These banks don't just make loans from their deposits, but will often own companies who are providing a product or service and making a return. These banks also create sophisticated financial products like mortgage-backed securities, for example, and sell them to investors. All sorts of things get grouped together and are sold to investors to generate a return. Auto loans will get grouped together. Even gym memberships will get grouped together because there's consistent payments. Investors will invest in those. The banks will buy them and pay investors a small amount for the privilege of using their money to purchase them. Investment banks also handle stock and bond transactions for clients. When you go to invest in treasury bonds, municipal bonds, all this type of thing, it's the banks that interact with the markets between the clients and the market makers that create these things. Investment banks also sometimes make their own markets. In 2008, with credit default swaps and credit default obligations, those markets are unregulated and are transactions in between financial institutions, which means the banks themselves create and make those markets. And they make a lot of money off the fees for all of that. They get investors in, they create these things, sell them to investors, and they make billions of dollars on fees for the privilege. And that's where banks make their money, on fees and interest from creating the financial transactions that allow a sophisticated economy to exist. Now, there is another type of bank that isn't really a bank. It's called a credit union. I wrote about them way back in 2014 when I first started what is now the Cameron Journal. They were started in the Depression and were owned by members, a group of citizens who would have money on deposit there, and then the credit union would loan out that money to other members who needed a loan. Credit unions are just that, a union. It's really a group of people who own and control their own financial institution. They're not a big company, they're usually local, and are limited in their size by regulations. The deposits are insured by a separate sort of insurance company controlled by the government. If you are a member of a credit union, as I am, you actually can vote on how the credit union is run. There are meetings you can attend, all sorts of things. There's a board. It's very different and much more accountable to their customers, because their customers are not just customers, they are members. Everybody who has money in a credit union owns a teeny tiny part of that credit union. Just like somebody who invests in a bank owns a teeny tiny part of the bank, well, in this case of a credit union, the credit union is owned by its customers. I'm a big fan of credit unions. I recommend everyone join one, but that's another story for another day. The last type of banks we're going to talk about is the banks of banks. Now, if you're a bank and you need to borrow some money, who are you going to borrow it from? Well, sometimes another bank. There are banks that handle what's called interbank lending. A lot of banks will borrow money sometimes overnight or for a short period of time to meet capitalization or deposit requirements. There are also clearinghouses for transactions in the stock market, for global trade, or for credit card transactions and transfers between banks. Banks oftentimes don't handle those themselves. There are clearinghouses that verify both parts of the transaction. For example, when you're buying a house and you put money in escrow, there's actually institutions that specifically handle that to prove that both sides have the money available in order to complete a transaction. If a bank needs to borrow money, they can do it from each other, or they can go to the Federal Reserve, or they can go to banks that specifically deal in lending money to banks based upon the assets and things they have available. Insurance companies also sometimes act as banks because they have insurance policies that are paid regularly that are a form of assets, and they also can sometimes act as banks by borrowing against the value of those insurance policies. All of these things taken together make our modern, sophisticated economy possible. Well, that is until our modern, sophisticated economy has a hiccup, like it did in the great financial crisis of 2008.
Mark, you there? Mark.
Paulson and Bernanke just left the White House. There's going to be a bailout.
Well, they had to. Right? I mean, paper markets would have
They
collapsed.
knew.
Cash would have stopped coming out of ATMs. They had to backstop this.
They knew the taxpayers would bail them out. They weren't being stupid. They just didn't care.
Yeah, because they're fucking crooks. But at least we're going to see some of them go to jail. Right? I mean, they're going to have to break up the banks. I mean, the party's over.
I don't know. I have a feeling that in a few years, people are going to be doing what they always do when the economy tanks. They will be blaming immigrants and poor people.
But Mark was wrong. In the years that followed, hundreds of bankers and rating agencies executives went to jail. The SEC was completely overhauled, and Congress had no choice but to break up the big banks and regulate the mortgage and derivatives industries. Just kidding. Banks took the money the American people gave them and they used it to pay themselves huge bonuses and lobby the Congress to kill big reform. And then they blamed immigrants and poor people. And this time, even teachers. And when all was said and done, only one single banker went to jail. This poor schmuck, Kareem Sarah-Geldin from Credit Suisse. He hit a few billion in mortgage bond losses, something most of the big banks did on a good day during the crisis.
Mark, can we sell now? I mean, the fund will make almost $1 billion. You'll clear 200 mil, Mark.
You know, once we sell, we'll be just like the rest of them. You know that.
No, we're not. We're not the bad guys here. We didn't defraud the American people and prey on their dreams of owning a home. All right, they did. Now we get to kick them in the teeth.
$1 billion.
That's right. But we got to close out our position or it could be zero. I mean, it's now or never, Mark.
Okay. Sell it all.
The end of banking regulations in the 1980s allowed banks to expand rapidly and find new ways to lend money, write mortgages, and encourage consumer spending with a disregard for the greater macroeconomic consequences. The best part was that they could make billions of dollars doing it, and in the case of mortgages, do it with securities that were fundamentally guaranteed by the federal government. Most home mortgages were owned by Fannie and Freddie, which were quasi-government institutions, and people believed that they could never fail and the government would always bail them out. So companies were willing to buy loans from Fannie and Freddie, package them into securities, sell them to investors, and make fees off of it, just as we've described. Banks also began investing for themselves and taking on investment clients, something that deposit banks used to not be able to allow to be done. Investment banks and regular banks were kept separate to protect depositors, but those lines blurred in the 80s. This change in banking regulation did not happen overnight, but in a series of small changes over time. One of the best ways to learn about this change is the introduction of the Oscar-nominated film The Big Short. Banks went from sleepy institutions that loaned out money and kept people's money safe to high-flying places that steered the engine of global growth. In the 1980s and 90s, banking quickly became America's biggest sector. No more was it steel or cars or consumer goods, it was banking. And bear in mind, all these people do are handle and trade money. This banking deregulation eventually manifested itself in the financial crisis as the highly sophisticated structures of credit collapsed. Now, remember back when I said that the aristocracy used to borrow money from the Medicis to finance large things beyond their annual tax revenues? The system of credit continues today. People only get paid every so often, so they borrow money in the form of personal loans, credit cards, all this type of things. Students borrow from their future earnings to make student loans. Companies may borrow money from payroll until they can sell off their invoices or get paid for all their invoices or have all their transactions clear. All this adds up to sophisticated structures of credit, and as long as all the people who owe money on the money loaned out keep paying, these structures of credit continue, and investing in credit structures allows more money to be loaned out. But if these things ever collapse, as happened to the Normans in the 13th century, then the whole economy can come crashing down. In the Norman period in Britain, they would keep track of their debts based upon their land revenues in a series of elaborate knots tied on sticks. And pretty soon, owning the sticks, i.e. the debt, became more valuable than the assets underlying. Stop me when this starts to sound familiar. Eventually, there was not enough people paying on the debt to keep those investments secure, and the Norman economy collapsed. A similar thing happened in 2008, but it was presaged first by the Asian financial crisis in 1997. Probably the biggest financial meltdown since the Great Depression, the Great Financial Crisis was for the United States what the Asian financial crisis did to Asia, particularly Japan. Japan already had a real estate bubble burst in 1991, and the Asian financial crisis doubled down the recession in 1997. Japan didn't even recover from the AFC until it was just in time for the Great Financial Crisis. Hell, 2008 was so significant, we're still talking about it. Multiple movies have been made about the events that began when the price of housing in certain markets began to fall in 2007, and the collapse of those debts and the amount of money owed and the calls on those loans began to create a full-on banking crisis in 2008. Now we know the rest of the story. The federal government bailed out the banks and other institutions like AIG with $700 billion in taxpayer relief funds, and $80 billion was just for AIG to insure its insurance obligations because it had foolishly insured all of these bad investments. So, how did these banks grow so large that McDonald's franchisees worried that Bank of America wouldn't be able to run their payroll at certain points in September and October of 2008? Well, quite simply, it had to do with financialization. The more money that was available, the more loans the banks made, the more they sold those securities to investors so that they would be able to make more loans. And the cycle grew so large and so out of control, no one person knew how bad the problem was. Nobody really knew how much debt was in the system. Nobody understood that the price of housing could go down because it had never gone down since the end of World War II. Nobody had prepared for the eventuality that those securities that the investors had invested in based upon those loans would eventually become worthless. And Because of that lack of regulation, the American economy and indeed the world economy nearly collapsed. And it irreparably changed our lives forever. A whole generation of people, including myself, was left bereft of jobs or any possibility for a future. People lost their homes, their futures. People who were renting and their landlords went under lost their places to live as well. 2008 changed everything for everyone, and life has never been the same since then. The amount of money that was spent to bail out banks was never given to regular people. The amount of help that was given to save the banks from basically collapsing and closing up shop did not save anybody's house. People with variable rate mortgages got foreclosed on. People that were unable to pay their debts and whatnot ended up in bankruptcy. It ended marriages. It ended families. And that's the thing with banks and banking that I think we forget in all the conversations that we have about banks and banking. We never think about the fact that those are real people with real money and real lives. And when all that goes away and all that falls apart, people's lives fall apart too. It's not just the repossession of a car or the foreclosure of a home. That's someone's whole life that's coming crashing down around their heads. Sometimes it's through fault of their own, but sometimes it's through no fault of their own. And oftentimes in the dog-eat-dog world of modern securitized and financialized capitalism, people just shrug their shoulders and say, try again next time. But for a lot of people, there isn't a next time. You know, you get to a certain age and whatnot, and you don't have as many years as you used to. And it's really hard to tell someone in their early 50s when they're staring down the barrel of retirement to give it up and start over. And it's hard to tell young people who can't get a job out of college or can't get a career off the ground to, you know, just wait and your time will come. And the years tick by and that never seems to happen. One of the things I noticed in my researching of the Asian financial crisis was how an entire generation in Japan in the early 90s was never able to secure any career or life for themselves. The same thing happened to a lot of millennials in 2008. The comparisons are rather shocking. And I will write about that one day in a book that will come out here shortly, and what a dramatic effect that is. And I think that's the part that we forget about when we talk about banks and banking, is that all of this adds up to people and money. Money is not just an esoteric thing. Money is labor, it's hard work, it's hours spent, it's getting up early in the morning, going to work, dealing with people you don't like. It is something you have to work for and save for and be careful with over a long period of time. And in another day and time before we had deposit insurance, all of that could be gone because a bank made a bad decision. And in 2008, people's lives were still sacrificed because banks made bad decisions. Banks are good, great institutions. A well-run bank can enable a lot of people to do a lot of great things in terms of starting businesses, making investments, growing for the future, buying a house, buying a car, sending children to college, all this type of thing. But run poorly, people can also be ruined by banks as well. And that's what makes them so incredibly powerful and so incredibly dangerous. Banks control our money and the lifeblood of our lives. They control whether we're going to have a car to drive, a house to live in, a future to think of. They control if we're going to have enough food to eat, how much debt we have to pay if we're able to have children. All of these things are predicated on being able to use money in a sophisticated society in a sophisticated way. And if those things are not possible, then whole parts of life and the American dream are just no longer available to us. And that's the real danger of banks. And oftentimes, thanks to these lax financial regulations, we have let banks spin out of control. And we have allowed them to become these sort of chess masters of the universe, controlling our lives in ways that most people, and indeed themselves, don't fully understand.
We come from every walk of life. We're proud of who we are and what we believe. We are among the 200,000 people who work for Bank of America.
I mean, why I earn the big bucks.
Yes.
I'm here for one reason and one reason alone. I'm here to guess what the music might do a week, a month, a year from now. That's it. Nothing more. And standing here tonight, I'm afraid that I don't hear a thing. Just silence. So, now that we know the music has stopped, what can we do about it? Mr. Cohen, Ms. Robertson, I'm afraid I think this is where you're supposed to step back in. Lord knows we've relied enough on Mr. Sullivan tonight. What do you have for us? What have I told you since the first day you stepped into my office? There are 3 ways to make a living in this business. Be first, be smarter, or cheat. No, I don't cheat. And although I like to think we have some pretty smart people in this building, it sure is a hell of a lot easier to just be first.
Sell it all today.
And when you can't borrow money, and when you can't start that business or go to school or buy that car, the whole economy grinds to a halt. When people can't buy cars, the people who make them don't have jobs. When you can't get student loans, you have fewer students and universities go under. Without all of these things that keep an economy going and functioning and happening, pretty soon everything grinds to a halt. And that's what happened. And that's why keeping banks well regulated and well supervised by the government, ultimately we the people, is vitally important. Well, I hope everyone has learned something in my little story about banks and banking, and I hope that this has given you insight as to how important banks are and how valuable they are, but how dangerous they can be, and how powerful the people who run them can be, and how much of our universe that they control. And I hope I've given you some insight into what the Great Depression was and is, and how the Great Financial Crisis was and is, and how banks can only work when they act well. And when they act well, that means they're regulated well. And that's something that all of us, any of us, who keep money in a bank or even a credit union should deeply care about. That's all for this episode of the Cameron Journal podcast. Thank you so much for listening. Visit us online at CameronJournal.com. We're on Facebook, Twitter, and Instagram, and I love to talk to my followers and listeners, so please feel free to get us on social media at Cameron Cowan on Twitter, and we'll see you next time on the Cameron Journal podcast.